I need to tell you about the dumbest financial decision I almost made when I was 20 years old. So I was scrolling through Wall Street Bets and I saw this post, and Wall Street Bets is just that popular subreddit. So a guy turned $5,000 into 47,000 in 3 days trading Tesla options. He posted the screenshot, everyone's congratulating him. I'm sitting there thinking, I have $3,000 saved up for my part-time job. If I could do that, I could pay off my student loans. I could actually get ahead. So I spent 2 weeks watching YouTube videos about option trading, call options, put options, strike prices, expiration dates. It seemed to make sense. So I opened a brokerage account and I was one click away from putting $2,000 into some options play I saw on Wall Street's bets. And then I stopped, not because I suddenly got smart, but because I did the math on what happens when this goes wrong. And what I want to talk about is the math, because there's this massive thing happening with people my age when it comes to gambling on options, and nobody's talking about the real cost. Before we continue on, my name's Michael, and I make videos like these financial videos to help younger people in their personal finances, because we're not taught this stuff, and sometimes we like to gamble our money and do stupid stuff. So in today's episode, I'm going to keep it short and we're going to talk about options. So let me start with what options actually are, because I think a lot of people see the screenshots but don't really understand the mechanics. An option is a contract that gives you the right to buy or sell a stock at a specific price by a specific date. A call option is betting the stock goes up. A put option is betting it goes down. Here's an example. Tesla stock is trading at $250 per share. You think it's going to go up to $280 in the next month. You could buy 100 shares for $25,000, or you could buy a call option for $500 that gives you the right to buy 100 shares at $250 anytime in the next 30 days. If Tesla hits $280, your option is now worth $3,000. You have the right to buy at $250 and sell at $280. That's a $30 profit per share times 100 shares. You paid $500, you made $3,000. That's a 500% return in a month. That's the appeal. You control 100 shares of a $250 stock for just $500 instead of $25,000. When you're right, you make insane returns. But here's what they don't emphasize. Options have expiration dates. If Tesla doesn't hit $250 by that date, your option expires worthless, like literally zero. You lose 100%. If you bought actual shares for $25,000 and Tesla dropped to 240, you lost $1,000, but you still have $24,000 worth of stock. With the option, if Tesla's at 249 at expiration day, you have nothing. So options give you massive upside, but also a ticking time bomb. You need to be right about direction and timing, which is what makes it so hard. If you're wrong on either, you lose everything. Now let me tell you what I see on Wall Street Bets and why it bothers me. There are two types of posts that blow up. The gain post, where someone turns $10,000 into $200,000, and the loss post, where someone lost their life savings. Both get thousands of upvotes and memes. Here's what you don't see though. The 50 people who lost $5,000 each for every one person who made $200,000. Those posts don't get upvoted. They're not interesting. So you get this skewed perception where it seems like everyone's making money. This is something called survivorship bias. You only see the winners because winners are the ones posting. All the people who quietly lost money don't show up in the feed. Let's say 100 people each put $5,000 into option trades. Maybe 10 make money, one person crushes it and turns 5K into 100K. That's what you see on Reddit, but the other 90 people lost their 5K. That's $450,000 in total losses versus maybe $150,000 in gains. The group lost $300,000 overall, but you only see the guy who made $95,000. And a lot of people losing are young, early 20s. I see posts from people losing $8,000 that was their house down payment savings, or $15,000 and now they can't pay off student loans. The mindset is always, I'll make it back on the next trade, like it's a video game where you restart the level. But that's not how this works. When you're 23 and lose $10,000, that's not just $10,000. Let me show you what I mean. This is the opportunity cost nobody talks about. You're 25 years old with $10,000 saved, and you have two options. Option one, you could put that $10,000 in an index fund and have an average return of 10% and don't touch it for 40 years. And that $10,000 will become $450,000 in the future. Or option two, you use it to buy options and lose it all. You have zero now, and you also don't have the $450,000 you would have had in retirement. The real cost of losing $10,000 at age 25 isn't $10,000. It's $450,000 in future wealth you just erased, all because you're not patient. So let's say you get lucky and you turn 10,000 into 30,000. You beat the odds. You made $20,000 in profit in a month. Except now you've proven to yourself you can do this. Why would you go back to boring index fund investing? So you keep trading, and eventually, statistically, you lose because options are a negative expected value game for retail traders. The option market is dominated by institutions with better information, better technology, better risk management than you. So when you trade options, you're competing against them. They win on average, which means retail traders lose on average. There are people who make money trading options, right? So professionals who do it full time, who they understand the math deeply. But if you're 22, watching YouTube videos and browsing WallStreetBets, you're not that person. So let me tell you why the odds are even worse than you think. When you buy an option, part of what you're paying for is implied volatility. It's the market's expectation of how much the stock will move. High volatility means expensive options. Here's the problem. Implied volatility spikes before major events. So think earnings, product launches, economic data. So options get expensive right when you want to buy them. So if Tesla is announcing earnings tomorrow, everyone knows the stock will move big. You want to buy a call option, but because everyone expects movement, that option that normally costs $500 now costs $1,200. And the next day, Tesla reports earnings and it goes up 8%. You were right. But implied volatility collapses after the event. So your option might only be worth $1,000. You were right about direction and you still lose money. And that's a huge concept many people do not realize. And then there's time decay. So every day that passes, your option loses value just from time passing. An option with 30 days until expiration is worth more than one with 1 day left. You're fighting implied volatility and crush and time decay. The stock needs to move in your favor enough to overcome both. The odds are stacked against you before you even start. Now I want to get to the most important part, which is the psychological trap. When you make money on an option trade, it feels amazing. You risk $500, made $2,000. That's a 400% return. You feel like you figured something out. You feel like you're Warren Buffett, like you have an edge. But in reality, you don't. You just got lucky. And winning early makes you more likely to lose big later. There's research on this when it comes to gambling. People who win early keep playing and eventually lose everything. The early win creates false confidence. You think you're good at it, and then you think you can repeat it. So here's my advice. Don't trade options, especially if you're young without much capital. I'm not saying never take financial risk. I'm saying options significantly are a trap for retail traders. If you want to take risk, there's better ways to do it. For one, you can start a business and build actual equity value. You can invest in individual stocks if you've done real research, and I do that. You can buy real estate if you can, learn a high income skill. All those have better expected returns than options. But if you absolutely insist and you want to trade options, I think there's 5 rules everyone should follow. So rule 1 is never risk more than 5% of your total savings on any single trade. $10,000 saved means a maximum $500 bet. Rule 2, only use money you can afford to lose completely. So no rent money, no emergency fund, not a house down payment savings account, none of that. Rule 3, understand you're gambling, not investing. So there's nothing wrong with gambling if you set limits, but don't confuse it with building wealth. Rule 4 is you have to track every trade for 6 months before evaluating if you're making money. One good month means nothing. And lastly, rule 5, if you're down 20% total, just stop completely. Don't try to make it back. But honestly, my real advice is just don't do it. Here's what I realized at 20, starting out, or I was 19. I had about $3,000 saved, and I just invested normally in stocks, put an extra $200 per month, and by 65, I'd have well over $1 million. It's not exciting. That's not Reddit screenshot, but it's real. If I gambled that 3,000 on options and lost, which is statistically most likely, I don't just lose 3,000, I lose the future compounding. I lose time I'll never get back. And even if I won, even if I turned 3,000 into 15,000, most likely I keep trading and eventually I lose it anyway because I don't have an actual edge. I'm just gambling. At the end of the day, it's just gambling. The people making serious money in options are market makers and institutions. They're the casino. When you trade options as a retail trader, you're the gambler at the blackjack table. The house has the edge. So here's where I ended up. I took that $3,000 and put it in stocks and index funds, which is boring. I got a better job. I kept investing, and now I'm 20 and I have over $15,000 invested. It grows slowly, some months up, some down. I'm not posting screenshots. I'm not getting congratulated by Reddit strangers, but I'm not stressed. I'm not checking my phone every 5 minutes. I'm not worried about losing everything. And I know in 40 years, if I keep doing this, I'll be fine. That's not the exciting path, but it's the one that actually works. If you've already lost money on options, I'm not judging you. I almost did the same thing, but take a hard look at whether this is building wealth or just expensive entertainment. And if you haven't started yet, think about the opportunity costs. That $5,000 you're thinking about betting, that's $226,000 in 40 years. Is the thrill of maybe turning it into $20,000 worth risking $226,000? For me, the answer is no, and hopefully it will continue to be no. So if this was helpful, subscribe. I'm making videos about money for people our age, cutting through the hype, and finding out what actually works, because we live in crazy times right now, and I'll see you in the next one.